Ladies and gentlemen, good day and welcome to Dollar Industries Limited Q2 FY21 earnings conference call hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Akhil Parekh from Elara Securities. Thank you and over to you, sir.
Thanks, Stephen. On behalf of Elara Securities, I welcome you all to Q2 FY21 conference call for Dollar Industries. I also wish all of you a happy Diwali in advance. From the management side for Dollar, we have with us Mr. Vinod Kumar Gupta, Managing Director, Ms. Shashi Agarwal, Senior VP Corporate Strategy and IR, and Mr. Ankit Gupta, Chief Financial Officer. I'll not take much time. I'll hand it over the call to the management of Dollar Industry for the opening remarks, post which will open the floor for Q&A session. Over to you, sir.
Yeah, good afternoon, everyone, and a very warm welcome in the earnings calls for Q2 FY21 of Dollar Industries Limited. As we know, everyone is knowing that the Indian economy has entered into unlocking phase where everything is gradually and slowly returning to normalcy. In spite of we beginning to resume our normal life, we are yet to experience complete normal lifestyle as pre-COVID times, and we are still awaiting the vaccine for coronavirus. Social distancing and safety measures are must for everyone. A lot has changed during the pandemic, and this pandemic has brought changes and shifts in consumer choices and their behavior. We have started observing a new way of doing and conducting business. We have seen changes in way the people travel, the eating habits, avail medical facilities, buy, socialize, study, and everything has undergone a sea change. One of the major shifts in the behavior of consumer is the adoption of e-commerce. Today, the consumer has started buying grocery online, taking medical consultations online. The education has also moved to online platforms. Among these, we are also observing that the consumers have shifted to online platform for buying the inner wear as well. This change in consumer behavior has brought a spike in online sales of the company. We have seen an increase of 44% in online sales for H1 FY21 on year-on-year basis. Looking at the current trend, the company has geared up for the spike and look forward to increasing online sales at 2x on full year basis. With every adversity comes new challenges and opportunities. We at Dollar Industries Limited also believe in this and help spread the opportunities by working on the innovations. The company in the last quarter had introduced antiviral range of products. The antiviral Dollar product range is well accepted in the market and by the consumers and has gained popularity. The newly introduced athleisure range has also grown up to 11% of the product category mix. We will continue with our endeavor to ensure that we change and adopt to the consumer needs and demands and their behavior constantly. In today's world where everyone is looking to cleaner and greener environment, we need to minimize our carbon footprint, and we at Dollar Industries Limited always believe in green mission. The zero discharge water treatment plant to recycle and use wastewater from the facility is one of the examples in helping building a clean and green environment. The company has already invested in windmill energy that helps us get the power in a cleaner and greener way and also at the reduced cost. In continuation of the efforts, the company has commissioned a 4 megawatt solar plant in Tamil Nadu near our spinning mill with a capacity of generating 75 lakh power units annually. This power plant will help curbing CO2 emission by 9,000 kgs a day with a sustainable environment. The power generated will be utilized in the spinning unit and excess heat and it will be utilized in the dyeing unit. This will help us to reduce our power cost in the spinning unit by 50%. The total investment into this solar plant is approximately 18 crores. It was funded through our internal accruals. Moving to the current status of Project Laksh, which the company started with Vector Consulting to implement TOC. The company has started appointing distributors in the area where previously the reach was not through direct channel. We have started serving retailers through our newly appointed distributors in Karnataka and Rajasthan, where our presence was either zero or negligible through the set of new distributors appointed under Project Laksh. After successful implementation in both the states, the company has started the rollout now in the states of Maharashtra, Gujarat, and Telangana. The project was slowed down during the lockdown period. However, we have accelerated the process now and targeting our focus and energy on the successful completion of the project. I shall also take immense pleasure to share with you the good work the team has been doing in generating free operating cash flow of 106 crores. This is the highest in the last 5 years as compared to 53 crores in the last financial year. This was achievable due to implementation of strict and stringent trade policies. The company is confident that it will be able to continue with the same policies going forward, and this will help the company in generating free operating cash flow. The free cash flow generated has been used for repayment of the debt to the tune of 100 crores in H1. The goal of the company is to become debt-free by the end of financial year 21-22, which will also help us reduce our finance costs as well to negligible level. I would also want to touch upon the last point before handing it over to Ankit for the financial review. As already pointed above, we have been strict with our credit policies with our debtors, which has a positive impact on the working capital cycle. The debtor days and inventory days have improved, and if you calculate them considering the fact that the company was operational only 135 days of the first 6 months, the net working capital cycle is calculated on that basis will be around 169 days. However, on 6 months basis, we will not see any improvement in the numbers. The company continues with its endeavor and is confident on reducing its debtors to 90 days by the end of this fiscal. This is all from my side, and I shall now hand over to Ankit to talk to you about the financial performance of the company this quarter. Thank you.
Thank you, sir. Good afternoon, everyone. The company's total revenue for the Q2 FY21 and H1 FY21 stood at rupees 258.98 crores and rupees 419.16 crores as compared to rupees 243.76 crores and 477.71 crores for Q2 FY20 and H1 FY20. So we see a growth of 6.24% for Q2 FY21, but we see a degrowth of 12.26% for H1 FY21. This is mainly due to the 45 days to 50 days of non-operation due to lockdown. The EBITDA of the company for Q1 stood at rupees 35.67 crores, that is 13.77%, and 64.50 crores, that is 15.39%, as compared to rupees 23.82 crores, that is 9.77%, and rupees 51.13 crores, that is 10.7%. So we see a growth of 49.75% on Q2 basis, and on H1 basis, we see a growth of 26.15% in EBITDA levels. The PBT for Q2 FY21 and H1 FY21 stood at 29.93 crores, that is 11.56%, and rupees 51.97 crores, that is 12.4%, as compared to 16.37 crores, that is 6.7%, and 36.33 crores, that is 7.61% for Q2 FY20 and H1 FY20. We saw a growth of 82.83% in Q2 FY21, and on half-yearly basis, we saw a growth of 43.04%. Now coming to the PAT levels, Q2 FY21, we stood at 23.39 crores, that is 9.03%, and on H1 21, we stood at 39.69 crores, that is 9.47%, as compared to 5.72% last year, Q2, and H1 5.65%. We see a growth of 67.67% on Q2 basis, and on H1 basis, we see a 47% growth. Now, moving to working capital, before I start, I would like to mention that the company was in operation for 135 days, as initial 45 days was under complete lockdown, where no operations happened. If we look at the working capital cycle on the basis of 135 days of operations, so the working capital would seem lower, but on apple-to-apple comparison, like taking 180 days as a whole, it would be somewhat similar levels. The debtors as on 30th September 2020 stood at 336.92 crores, which is approximately 150 days, but on 135 days basis, it's 112 days, as compared to 133 days as on 31st March 20. The inventory as on 30th September 2020 stood at 293.02 crores, that is 128 days. If you see on 135 days basis, it's 96 days, as compared to 118 days as on 31st March 2020. The creditors as on 30th September 2020 stood at 126.42 crores, which is 53 days, but on 135 days basis, it's coming to 40 days, as compared to 50 days, which stood at 31st March 2020. So the total working capital cycle stands at 225 days if we see 180 days as the complete time frame, but on 135 days basis, it is 169 days, as compared to 201 days, which stood at 31st March 2020. The company will continue its endeavor to reduce the debtor days by working with its distribution networks and working on stringent credit policies, as also highlighted by our MD sir, and we are sure that we'll be able to further trim our working capital cycle. Now moving on to the revenue breakup, Q2 FY21 and on half-yearly basis as well. So in Q2, Big Boss stood at 40%, but on half-yearly basis, it stood at 41%. The SOX is at a similar level for Q2 and half-yearly basis, which is 1%. Force Go in Q2, we stood at, it contributed around 3%, but on half-yearly basis, it contributed to as 4%. Force Next is same 2% for Q2 and H1. Missy is 6% for Q2 and 6% for H1. Regular, which is our economy range of products, Q2 we saw a contribution of 33%, but overall H1 basis we saw a contribution of 37% by the economy range of products. Thermals on if you see Q2 is the time period where we start our supply for the thermals, which saw 14% contribution coming from thermals, But on H1 basis, it would be lower since first quarter is zero sales for thermals. So it's 9% on H1 basis. Now, quick update on our JVCO company, Pepe Jeans Inner Fashion Private Limited. The total revenue stood at 5.48 crores for the quarter, as opposed to 6.83 crores for, and 6.83 crores for the half year ended. The loss from the joint venture for the quarter stood at 69 lakhs, and for half year, it was 1.2 crores. So our share of loss would be 35 lakhs and 60 lakhs respectively. I now open the forum for the questions and answers, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shalini Gupta from Quantum Securities. Please go ahead.
Yeah, good afternoon to everybody. Ma'am, I just wanted to ask you one or two things. Like, one is that when I look at the gross margins have seen a very sharp increase by almost like 1,000 bits. And and the top line has grown by only about 6-7%. So the sense that one carries is that you are probably sort of gunning for realization growth rather than volume growth. That's one sense that I carry. The second thing is that when I add the subcontract expenses and the raw material expenses, then the increase is not that much. So if you could just please talk about these things. Hello? Hello?
Members of the management?
Hello?
तुम्ही ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉलला होल्डवर ठेवला आहे. कृपया
Ms. Gupta, request you to please stay connected.
Yeah.
Ladies and gentlemen, the line for the management is disconnected. Requesting you all to please stay connected while we reconnect them. Participants, the line for the management is reconnected. Over to you, Ms. Shalini Gupta.
Yeah, good afternoon, everybody. I had one is that when I look at the gross margins have seen a very substantial jump, like almost like 1,000 bits. So that's one thing. So the sense that I carry is that you know you are and the top line has grown by 6%. So I mean, would I be correct in thinking that probably the management is following a strategy of pushing realizations maybe at the expense of volumes? That secondly, if I add contract expenses and raw material costs,
Ms. Gupta?
then
Ma'am, so sorry, but your voice is breaking up in between, ma'am.
Okay, so let me go to. Can you hear me now properly?
Yeah, now it's better. Yes.
Okay. Okay. So basically, when I look at the gross margins, there's been an increase of like a very substantial increase of like almost 1,000 bits. So the sense, and the top line has grown by 6%. So the sense that I'm getting is that probably the management is focusing more on realization increase versus pushing for volumes. If you could just comment on this, please. And the second thing is that when I add, can you hear me now?
Hey Shalini, we can hear you. Please go ahead.
Okay. Okay. The second thing is that, see, when I add the raw material costs and the subcontract expenses, then probably and divided by sales, obviously, then the increase is not so much. So is it that you are subcontracting more, or I mean, if you could just please talk about the management strategy and also about subcontract expenses. Are you increasingly subcontracting, and therefore these sort of numbers should be visible going forward also? If you could just please talk about this. Basically about the gross margins, are you following a strategy of pushing realization as opposed to volumes? That's one. Second, about subcontracting, I mean, what is your take on this? Subcontract, yeah, if you could just talk about this.
Shalini, I'll take this question. So to your first question, is the management pushing volumes or is management focusing on margins as well? Definitely the management is focusing on margins. That's precisely the reason we have got under the new model of, replacement model rather than push sales model. That's the reason we partnered with Victor Consulting Limited, where we are trying to implement the theory of constraints in terms of where the entire channel, my entire supply chain would work on replenishment model. And we will gradually do away with the push model system. So definitely that implementation is on the way, is starting, and we have seen good results both in Karnataka and Rajasthan, and being overwhelmed with the results in both the states. We have also started implementing the same particular model in Maharashtra, Gujarat, and Telangana. So this particular process was kind of slowed down, as already highlighted by our MD, because of the lockdown phases, restrictions in travels, etc. Because this required a huge amount of on-field presence by the team. In the meantime, what we were doing is during the lockdown, was we were trying to work across on the our operational back-end system, where we got a lot of things in place as well. And still, but there's a lot to do. It's just the start of the tip of the iceberg right now for us. So this is definitely being taken care of. Precisely one of the reasons you are seeing that margins are improving. But again, there are 2-3 factors to be taken into consideration. Because under this particular model, when we are talking about the replenishment model, we are also talking about the universal pricing, as opposed to the pricing which currently goes on, where you don't go to the market, nothing is available on the MRP basis. So definitely this is one more thing which we are trying to implement, is a universal price list at the retail level. And we have been able to do it in Rajasthan and Karnataka. Rajasthan being one of the biggest selling states, where nothing sells on MRP. So when we have achieved this success, we definitely want to implement this across our ecosystem. That's one. Number two, definitely as we start working onto our back-end systems, that will give a better gross margins. Again, because of the inventories which we will be able to carry, the work in progress and other things would be rationalized. Today we have inventories. Maybe the number of inventory days would not, number of the count may not come out, but the rationalization would happen in terms of having the right kind of inventory at disposal. So this will give us, will make sure that the sales loss are covered in this particular process as well. So a lot of work going on at the back end, Shalini. But again, to your question, if we combine this question with outsourcing versus in-house manufacturing, we do not want to increase our in-house manufacturing capacities. But we will see savings happening to us. Like one of the steps which we took across was the solar plant, installation. We commissioned the solar plant this quarter, and we see that 50% of the savings would come in terms of the power cost. So these kind of small little steps again would help us to conserve, move towards, number one, the basic concept would be to move towards a cleaner and a greener environment, having eco-friendly manufacturing facilities, but also would help us save cost. So there would be many factors that the management is currently working across to ensure that we are saving cost, as working on the margins, and also contributing to the society. So this is how it is. Subcontracting, the reason is you would see this the savings which is there, as you rightly pointed out, if subcontracting and material consumed taken together, there is not much of a difference. But in isolation, you will find a lot of kind of a difference in terms of your gross margin is concerned. On half-year basis, it's just a 300 bits. There approximately, so not even 300, I would say, yes. 35% was what we had in last half-year ended, and this year it is around about 39%. So those savings comes again from the price dip which we got this particular quarter. There was a huge decline in material cost. 15% material, the price of the cotton was down this particular during the phase of lockdown, which has bounced back, and we going ahead also see again the increase in cotton prices to the tune of 7 to 8%. So whatever benefits we could get and derive there, we have taken that, and that's one of the reasons you can see that dip in material cost.
Ma'am, then see, I mean, the first quarter margins were like 17-18%, and this quarter probably because of lower ad expenses. This quarter margins are a little lower, so probably because of higher ad expenses. So two questions: if you could say what the ad expenses were in the first quarter as a percentage to sales and second quarter now, and also what is the outlook on EBITDA margins? How should we project for the year and for the next year?
Yeah. So in first quarter, our ad expenditure was around 10 crores. So that was basically due to the launch. So we launched a new brand architecture, and that is the reason why we had to spend in the first quarter, and also spend some of the advertisement expenditure in the second quarter as well. So in the second quarter, it was around 16.5 crores. So in totality, if we see half-yearly basis, it's around 26 to 27 crores of ad expenditure, vis-a-vis the last year half-yearly, where we spent around 44 crores. And with respect to the EBITDA guidance, we see a good rise in EBITDA this year. So by the fiscal end, we see around 14 to 15% of EBITDA levels.
Okay. Okay. Yeah. Thank you so much. I'll come back in the queue if I have more questions.
Thank you. Yeah.
Thank you. A reminder to the participants: anyone who wishes to ask a question may press star and 1. The next question is from the line of Pranay Zaveri from J&J Holding. Please go ahead.
Good afternoon, sir. Congratulations on good set of numbers, and thank you for giving me this opportunity. Though in your earlier remarks you have explained some part of your working capital, but if you could just elaborate in terms of the levers where you see this working capital days going forward. That is my first question.
I'll take that one. So, if you really individually, if you just evaluate our working capital cycle pre-COVID times as on 31st March, you will see that only lever which is actually distorting our working capital cycle is our debtors. Inventories, it's just by 10 days, that will not be a big thing to put it down. Whatever done, 90 days of inventories is required in our trade and business, because we have raw materials to cater to, we have finished goods, lot of SKUs, items, pan-India distribution, etc. So inventories 90 days is kind of something which we are right now targeting, and that's not a difficult thing to achieve. The only lever which is actually distorting our entire working capital cycle is debtors, and we got a very good opportunity to work on this during the pandemic situation. During this particular situation, it was more kind of in seller's market than the buyer's market. We've always, feared that, if we tighten our debtors, we might have an impact on our sales. And due to this particular reason, we were always a little friendly and lenient to our debtors. But this particular situation where the supply was limited, the demand was high, we had actually very strictly were following our credit policies. It was absolutely first clear your old debts, and then we come and we can always talk about supplying you anything new. This maybe in terms of numbers, and as Ankit already spoke, that if you look at the numbers at 180 days level, the numbers have not come down. But considering the fact that all the sale has happened in only last 135 days, the debtors numbers are pretty good. So that means that, and it's also reflective in our cash flow statements as well. So that's where we can see that, a lot of debts going down, a lot of liabilities, a lot of other collections happening. So here we have understood that rather as a policy, the management has decided that we will strictly follow our 60 days credit policy with our debtors and consumers, and so be it. So this is one of the levers which is definitely going to help us improve our working capital cycle, and that's the reason the management is so confident about it.
So what would be your target going forward at the exit of FY21 and FY22, a broader picture, in terms of your net working capital cycle?
So what we are looking at as on FY21 is debtors we are targeting at 90 days, and stock we are looking at somewhere around about 70 to 80 days. That's something we are working along with the team, Vector Consulting team now also, so that they can rationalize and work across on the backside of our production cycle.
So what would be that for the net working capital, if I may just?
90 plus 80, even if I take on the worst case scenario, that would be 170 less 40-50 days of credit terms, which we get from the creditors. So 170 minus 40, around about 130.
By the end of FY21?
Yeah.
Yeah.
By the end of FY21.
Okay, and any targets for FY22? Or that will be a little too early to call for?
No, it will be too early, but then as I have already spoken in my opening statement, that we are going to make this company debt-free by the end of FY22.
Okay.
So unless until we generate a good amount of cash flow, positive cash flow, we have not been able to wipe off our debts. So we are taking steps to make this company debt-free by the end of March 22.
In terms of this consultancy, so basically we are getting advice only on the working capital, or is there something in terms of the approach for sales or the target or the market, the competitive landscape also?
So when we talk about Vector Consultancy, so it's on both the front. It's improving our supply chain back-end operations as well, bringing efficiencies into it. And also in the sales front, it's all about reach and range. So it helps us penetrate into the market where we are not present yet, and also increase our retailer base, plus increasing the number of SKUs, like the stock keeping units at the retailer level as well. So during our rollout period, like when we rolled it out to Karnataka or Rajasthan, we were able to enter into grey areas where we were not present. Like in Rajasthan, we have Barotra, Pali. So these are some talukas in Jodhpur division where we were not present earlier. But now we have a distributor there selling our products, and the retailers are really welcoming our products. And they are happy that we were initially being supplied by small semi-wholesalers, but now they are being supplied directly by the distributor and as per their choices. So this is one thing which we see positive with the Vector Consultancy on the sales front. The second thing is the range. So earlier, so let's say Postnext. So Postnext had a different kind of a working, had different distributors. But with Vector, a particular distributor under a Vector project has to sell all the products of Dollar Industries Limited, including Postnext. So now we have started getting attraction for Postnext products also, just because now the people, the telecallers or the field TSOs which we have in the market, they are going to the individual retailers, advocating for the product, and they are happy with the product range. So earlier, what we were not used to sell, or a distributor were not used to keep a certain, let's say, a certain brand. So now they have started selling. So we have started increasing our reach as well as the range in the market. So this is how it's helping us in the sales front, and also supply chain is a part of their contract. So still working on the back-end operation to make it more efficient.
Thank you. I'll come back in the queue in case I have any questions. Thank you so much.
Thank you. The next question is from the line of Lakshmi Narayanan from ICICI Mutual Fund. Please go ahead.
Yeah, couple of questions. First is that you have close to around 950 distributors across the country, and you also have these agents who would actually appoint distributors, right? Now, given that you are actually, hello?
Ryan, but we are not able to understand you clearly.
Yeah, is it better?
Not really. We are not able to get the question.
You're not able to hear me. Okay, is it better now or is it still difficult?
I think if you're on a speaker phone, if you could make it hands-free and take it out.
Is it better?
So it's better if you talk on the handset mode, sir.
Yeah, I'm talking on the handset mode only. You have around 950 distributors, I believe, and then you also have people who appoint these distributors. That there are some commission agents, etc. Now that you are actually making changes in your distribution, theory of constraints, etc., I just want to understand how this entire distributor network will get revamped. And the second question which I have is that in terms of the volume of units, which is Big Boss and the economy range which you talk about, how the volume growth has taken place in the first half and compared to the first half of the previous year.
Okay, sure. So first I'll start with the distribution model which we talked about, that how well it is going to be accepted in the distribution community we already have, number one. Number two is what is their reactions and how we are partnering with them. So here, I would say yes, definitely we have an existing network of 800, 900 distributors into our current system who are working into kind of in conventional method of trade. But let me tell you one thing. Whenever we have gone to a distributor and talked to them about that particular methodology of replenishment model rather than the push model, the first reaction which we got from them was always positive. They have been always positive about the changes which the company is about to bring into the system. Because trust me, even they understand that the working capital is getting blocked for them. They're carrying the inventories for 3 months, 4 months, as opposed to if we talk to them about a replenishment, selling or sending them the materials every fortnightly, every month. That's a kind of music to their ears. They really love hearing about it. The only challenge which happens is when we talk to them, is when we talk about the other replenishment model, they have to go to the retailers in the same way they have to work, and they have a limited and restricted area, and they have to work on a universal price list. So there are certain conditions also which comes along with our particular model when we implement them. So initially, it takes us time to convince them. Once they understand and see that the model is really working fine, it is not very difficult for us to convert them into our existing models. And also with that, once you are starting working on the replenishment model and you're billing them very frequently, your collection starts improving. It also helps us, whenever we have to get the next order placed, you always talk about that first you have to make the payments which is due. The credit terms also we are trying to redefine here, which we have brought down to 45 days here in our new model. That's also going to help us reduce our debtors. So basically all systems, it's all hand in hand when we are talking about so confidently about our numbers of 90 days coming in, because there are a lot of working which has happened in the last 1.5 years along with this. So that's how the distributors have been there. And The ones which are not falling in line with us, gradually we are going to prune them from the system or kind of limit and restrict them. Not immediately, but with time it would definitely happen. And there have been some examples where we had to choose difficult choice, but we had gone that way.
And in your other expenses, around 14 crores is paid for commission and brokerage, which I understand is that there are some agents in the middle between you and the distributors, and the agent's role is to go and appoint these distributors, etc. Now, are you? Will there be some rationalization of that expense also?
Not immediately, because we plan on keeping our agents who have, the company has been appointing agents in all the states, and we have basically the state is monitored and run by the agents, because they also take the responsibility of the payments from the debtors. So we will continue with the system. We will think about it once we have covered the entire India under this particular system. Probably that's a call that we need to work across once we reach there. So it's a long shot right now.
Got it. And in terms of the volume of your main product, which is the Big Boss and the economy range, and how the ASPs are actually moved, how the volume has actually moved, and what's the kind of touch points you actually reach through these 900 odd distributors?
Sorry, I did not get the last bit, Mr. Narayan.
Yeah, I mean, through these 900 odd distributors, how many end points you would actually reach in India? I mean, your absolute reach of end points, approximately. And then what is the volume growth as well as the ASP growth of Big Boss and the economy range?
Coming to the volume change and the ASP level as well, on a quarterly basis, year on year, we see that Big Boss has contributed around 40%, with respect to 43%, which was last year. It was mainly taken over by the economy range of products, because we see a 3% growth in our economy range of product as well in terms of contribution. The change in ASP, so overall at a company level, we saw a decline in our ASP. Earlier it was 61.87, which is now 56.57 on quarterly basis. But on a half-yearly basis, we see overall ASP as 54.33 with respect to 59.47 last year half-yearly basis. In terms of volume change, in Big Boss on half-yearly basis, we saw a degrowth of 17% in terms of volume, but an increase of 21% in the volume of our economy range of products. Also, we saw in thermals, we saw a volume change of 90% on half-yearly basis. But on if you take the ASP basis, there was a 1% change in Big Boss towards the positive side. But in the economy range of products, we saw a decline of 14%. Our total touch points in the market is around 110,000 retailers currently, which is spread across 950 distributors and pan-India basis.
110,000. Okay. Thank you so much.
Thank you. A reminder to the participants, please limit your questions to 2 per participant. Should you have any follow-up, request you to rejoin the queue, please. The next question is from the line of Prerna Junjunwala from B&K Securities. Please go ahead.
Thank you for the opportunity and congratulations on improvement in working capital as well as resumption of pre-pandemic level of sales. Just wanted to understand how the demand scenario now that economy is now largely open and there are no major lockdowns across the country. So though work from home, even offices have started. So how is the demand panning out across regions or across the country, and how is the inventory in the supply chain at adequate levels, or if you could highlight some changes that could have happened in the inventory on a year-on-year basis in the supply chain system?
Yeah, I'll take this question. Right now, demand of the product in the market is really very good. And it's not only this country we are having a good amount of demand, but abroad also we are getting good orders. Because of, if you talk of overseas market, there are some, I don't know, these overseas markets are experiencing low supply from China, maybe because of that China factor. They are also working. But demand for our product is really very good right now. In the domestic market also it is very good. Now if you look at the thermal, which is the special product for this winter season ahead, the demand is really good because of winter setting in a little bit, earlier. And what we are experiencing from the weather forecast, we are now
Members of the management, sorry to interrupt, but your voice is breaking up.
Yeah.
So sorry to interrupt, but your voice is still breaking up, sir. Ms. Junjunwala, request you to please stay connected.
Sure.
Participants are requested to please stay connected while we reconnect the management. Ladies and gentlemen, the line for the management is reconnected. Thank you, and over to you, sir.
Yeah, if you look at the demand for the thermals, if you talk of 2018, 2019, the demand in the last 2 years was very good, and there is no leftover or carryover of stocks. And this year also, by God's grace, the winter has set in earlier, and now there is a good demand from the market. And we are also, what we are viewing the weather forecast, this year the winter should be long drawn. The number of days for which the winter is there, it's going to be a larger period. Maybe till 15th of February, there should be a good amount of demand of the thermal products. So the demand for the product is really good if you talk of cotton, and it's also really very good if you talk of thermals. So from the demand side, there is a force from the market for the, and we are also gearing up our supply chain to cater to those demands well in time. We are fully equipped, and we don't see any dearth of any shortfall in the supply chain. Supply chain is well monitored and well equipped. Thank you.
Okay. And sir, you were focusing on exports market. Could you help us understand how has been the export market performance? What would be the contribution of the same in the quarter or in the first half versus last year?
So, hi Prerna, this is Ankit here. The thing is, if we see on H1 basis, the export percentage is around 5.5% vis-a-vis 7%. But we have to keep in mind one thing, that in the first quarter the sales for the export was 0. So whatever contribution has come in the second quarter itself. So if we bifurcate our total sales, 92% is domestic, around 5.5% is exports, and 2.5% is what we received from our modern retail chain, which includes majorly of e-commerce and some amount of sales in the large format stores like Brand Factory or the other.
Okay. And so you mentioned...
Yeah, Prerna, we definitely have a good pipeline in terms of orders are concerned from the Middle East countries, and we are very hopeful and positive about this export numbers to go ahead in the third quarter and in the next 2 quarters.
Just a follow-up on this, ma'am. In exports, we are selling under our own brand. No, which brand we must be exporting it under?
So it's under the dollar brand only. We are the only company which exports in our own brand name, dollar.
And that is Big Boss. So we have Big Boss going. We have Missy. We also have some thermals which are being exported.
Okay. Okay. And could you just elaborate your strategy for online sales? As you said that in the initial comments that the company would be focusing on e-commerce and online sales going forward, as it has come up as a new medium for sales in the pandemic times.
Yes, so we saw a very good demand in our e-commerce channels. So all the major channels like Flipkart, Myntra, Amazon, uh, Ajio, which is growing at a good level. So in all those platforms, we are getting a very good traction for our sales, especially Missy, in which our wholesale sale, like traditional channel sales have not increased that much, but in the online we are getting a very good traction. Athleisure is one segment where we are getting a good traction online as well as our wholesale. So going forward, the total sales of our e-commerce is around 2% of our total sales right now. So this year we want to grow at a 2x level. But going ahead, e-commerce, we see a huge potential in e-commerce, but as a percentage of our total sales will still be lower, as our traditional business channel or a traditional way of business is much larger in terms of volume and value.
Okay, so basically it will...
Ms. Junjunwala, ma'am, so sorry to interrupt, but for any follow-up, request you to rejoin the queue, please. A reminder to the participants, please limit your questions to one per participant. The next question is from the line of Anil Desai from Marcellus Investment. Please go ahead.
Thank you. So can you speak a little more about your new brand architecture, specifically from a pricing spectrum? What all segments will you span, and where will be the largest contribution to your revenues coming from?
So, like before brand architecture, there were a lot of sub-brands that we used to carry, like Dollar Big Boss, Dollar Leher, Dollar Comfort, Commando, Bravery, Dollar Missy, Dollar Champion, Dollar Socks, Dollar Ultra, Dollar Winter Care. So there were n number of sub-brands that we had, and all the logos were different. Only the dollar logo was the constant part in all the sub-brand logos. So we thought and underwent a change wherein our logo was completely modified. It's a brand new logo, gives you a fresh feeling, a positive vibe when you talk about or when you see the logo with a mnemonic which is knitted as double D if you see it closely. So we got in touch with a couple of consultants, and finally we boiled down to one consultant, which is Lin Consult. It's a wing of Lowell Intas worldwide, and they suggested why just logo change? Why not the entire brand architecture, wherein it would be really very easy to promote all the brands together as well, and also little less confusion in the minds of consumer. So earlier, dollar used to be perceived as a male centric brand. All the communication, all the advertisement was more towards masculinity, macho kind of a thing. But after the brand architecture, after the new logo introduction, and all the changes that we have made, it's more towards gender neutrality, where Dollar is kind of a family brand wherein kids can shop, a woman can shop, or men can shop. And how we categorized in our new brand architecture is we have Dollar Man. Dollar Man contains Big Boss as a collection. Then we have J Class as a collection, which is an upgraded version of Big Boss, and we have Dollar Man Athleisure. So Athleisure is the new addition that we had last year. The second category is Dollar Woman. In Dollar Woman, we have one collection that is Missy. Then we have Dollar Junior, which deals with a kids range of products, and the collection name is Champion and Kids Care. Then after that we have Dollar Always. In Dollar Always, what we have done is earlier we used to have economy range of products under different sub brands like Leher, Bravery, Commando, Comfort, Egyptian. So all those kind of sub brands have been merged to Leher, and now under Dollar Always we have a collection called Leher, which contains all kinds of economy range of products that we have. The fifth and the last category that we have is Dollar Thermals. It has Ultra and Winter Care as their collection. So Ultra is a bit premium thermals that we manufacture in Ludhiana and Calcutta, and Winter Care is a bit economical than Ultra, and we manufacture it in Kolkata itself. So this is how we have characterized all the sub-brands into 5 categories, and each category is self-sufficient. You might ask that what happened to Dollar Socks, which was earlier a separate sub-brand. So what we have done is each category like Dollar Man, Dollar Woman, Dollar Always, Dollar Junior, Dollar Thermals, all the categories have their own socks range. So Dollar Man has its own socks range, Dollar Woman has its own socks range. So this way what we have done is we have consolidated a lot of categories, sub-brands, and made it a more simpler one and easy to understand for the consumer. However, Post Next and Post Gowear remains the same as before, because we don't use the word dollar there. They're individual standalone brands that we have in-house.
And does this also change your focus or priority on which categories will you be focused, which categories will be more important for you, or that remains unchanged? Does Leher become more or less important after this change, or the focus is retained as it was earlier?
I'll take this one. So what, as always, the Leher is an economical range of products. The volume, it will always give us the volumes, but the value proposition would definitely come from Dollar Men and Force Next and other brands. Is that focus that means we have to have equal energy and focus on all these 3 categories, because we cannot let the volumes go, because that definitely gives us the volumes are there, and even the EBITDA margins are lower there, but we have to also keep in mind that the advertisement expenses are lower there as well. So the margins is more or less kind of in 8-9% which we get there. If we have to go higher, Big Boss would definitely be a mid-premium segment, which is kind of, and again would be the volumes comes there. Premium ranges is catered by Force Next, and if we go further ahead, Pepe Jeans, JV Co, which we have already taken up. So the focus, I would not say that there is one particular brand which is getting neglected, or one particular brand is getting promoted over the other. It's not that. Equal energy and focus is devoted to all these brands. Yes, that's one particular category if I have to speak about is Dollar Kids, which really needs a little more attention, because there's a huge potential lies ahead for us there. There's one thing, this is one category where we need to divert our energies, because Missy has been doing well with, greater energy and focus there. The bottom wear, the leg wears for the women have been doing wonderful. Just the pandemic times, I would say that the sales were down for the legwear. Otherwise, Missy was gathering good traction there. Post-Next has also done good for us. Leher economy ranges and Big Boss has always been there for us. So I think so. No particular preferences goes to one particular brand. Equal energies and efforts is driven in all these brands.
Great. Thank you very much.
Thank you. The next question is from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, good afternoon, team. Just wanted to have a sense in terms of what is the working capital cycle in Karnataka and Rajasthan, given that TOC has been implemented in both these states now?
Mr. Buddhadev, out there, I would say the number of distributors which we have rolled out is like, we have touched around 20 distributors in both the states. So definitely it's around 50% of what we have. But the working capital cycle has not been individually calculated there, but what we can say that yes, they are well within, especially the Lux distributors have been well within the limit and timelines of their credit policies.
Okay, and in terms of ad spend for this quarter, is there been a growth on a YOY basis or how is it?
Sorry, I did not get that question, sir.
The advertisement spend in this quarter was about 16.5 crores, right? What was it in the same quarter last year, advertisement spend?
Okay, so I would suggest that we should not look in the same quarter-to-quarter basis, rather look at a half-yearly basis, because second quarter is always dull for our advertisement, period. So in half-year basis, we had spent 43 crores in 6 months ended, whereas this year we have just spent 29 crores. That's a 35% decline in advertisement expenses. Overall, it's a 6% to my sales.
No, so the reason I was asking for the YY trajectory is that should we expect ad spends to now see an increase with recovery being visible, or how should we look at it in the second half?
For this particular year, we have targeted 65 crores as our advertisement expenses.
And what was it last year?
Sorry?
What was it last year?
23 crores, sir.
Okay. And lastly, is it fair to say volume growth at the company level in Q2 was around 15%?
The volume of growth of the company?
In the
overall level?
Yeah.
For half year basis, the volume change has been more or less same. We said...
second quarter?
Second quarter, definitely, there has been a 20% volume growth.
20% volume growth. Okay, thank you. That's it from my side.
Thank you. The next question is from the line of Kimberly Pace from Anand Rathi. Please go ahead.
Yeah, hi. Thank you for taking my question. So basically, I just want to know on the other expenses front, there has been an absolute reduction in H1, obviously because of the low operational days as well. But going ahead, is there any structural cost that we'll be carrying forward, or will other expenses continue to be around 19-20% of our sales?
See, Kimberly, major expenses which form part of this other expenses is the advertisement part of it.
Right.
And we don't see that going up because we have capped that at 60 crores for this particular year. So we've already spent 29 crores this 6 months, and we see another 30 crores going. So it's a 50%. Probably I will not see a very big jump in terms of my other expenses concerned.
No. Like going ahead, like for FY22, FY23 onwards, like any structural reductions that we're taking with us, or?
Advertisement expense, the way we are moving in the market, our goal is to, again, I would say that we've seen more in the market rather than seen more on the TV there. Because, the impact which in consumer when he walks into the store and he sees the dealer boards of Dollar Industries everywhere, that has high impact rather than the advertisements which runs on the TV. And the expenses which is incurred on the TV runs vis-a-vis both they are way two different numbers they come up oppositely north and south. So definitely that's a plan which the company has going ahead. So the advertisements would be done, but they would be done in a more rational and organized manner.
Okay. All right. Yeah. Thank you.
Thank you. The next question is from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, I just wanted to understand that share of economy range has increased for us. So how has been the month-over-month trend in terms of consumer preference for economy variants versus the premium variants?
The reason for this particular change is because, even during the pandemic situations, the demand was majorly coming from your inner, suburban areas, rural areas. Urban areas, major cities were closed down. Maharashtra, for example, was closed down to a bigger extent. That was the last city to open up. Major cities, they did not open up. Even today in the cities, people are scared. As opposed to when you walk down to the rural areas, you'll see people moving freely and maybe not having that being impacted. Though they do not understand the impact of the severity which we need to follow the stuff. They've been opening up their shops. So there, I would say this is more kind of in current situation which has made a shift from big box to a regular level of products. But this is not something to stay. As we resume our life to normalcy, as we move ahead, we have seen malls opening up, we have seen departmental stores gradually opening up, people gradually moving out to buy either through the online channels or through some other after taking the safety measure precautions. Because see, here we have to understand that this is not a discretionary buy. This is something you might postpone, but you cannot do away with completely. You might, even if you're staying indoors, no matter whether you're staying indoors or you're moving out for work, you definitely need a pair of your innerwears.
Right. So, with further unlocking, you believe, because our recovery has been pretty strong, and so with the unlocking trends, with cities also contributing, do you think that the volume growth will be far better than the expectations?
Yes, absolutely. We are very, very confident about it. And that's how we are actually working around as well. As already highlighted by Ankit and the MD sir, that we are working on our online channels. We are working we are approaching or moving into the areas which we previously not penetrated or that was just kind of left wide. Or, the existing distributors, we have been serving them well. So we see this happening, the demands coming in back and the volumes going up. That's something we are working across.
Wanted to take your thoughts on the difference in working capital requirements for traditional distribution channel and e-commerce channels. So
in e-commerce, what happens is when you sell a product today, the amount is credited to your account in the next month after 15th. So it's around 45 days to 50 days payment period in our online sales. Vis-a-vis in our traditional business, currently we are at 112 days.
So with share of e-commerce increasing, this will also contribute to working capital improvement, right?
But what happened is when you talk of online sales, you need to carry a lot more inventory than what you have in our traditional sales level, because in online you sell piece to piece basis and not a trade pack basis. So a trade pack generally contains 10 pieces box for our wholesale business, but in our e-commerce operations we sell piece to piece basis. So you need to carry a lot more stock than what you have in our traditional sales. But overall, going forward, while we increase our sales online, the percentage would be still smaller than what we are at today. So currently, if we are at 2% of our total sales coming from e-commerce, that would be what 3.5% at a year-end level. So that would still be very small to.
Ladies and gentlemen, requesting you all to please stay connected. The line for the management is disconnected. Ladies and gentlemen, the line for the management is reconnected. Thank you, and over to you, sir.
Yes. So I was saying that online sales contribution to our total sales would still be at a very low level to make a considerable change in your debtor days or inventory days, I would say.
Sure, sir. That's helpful. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take the last question from the line of Ritesh Barjatia from Asian Market Securities. Please go ahead.
Hi. Thanks, management, for the opportunity. So most of the question is answered. Just one question is on the distributor side. If you can quantify what kind of the ROI distributors are making under the old distribution model, and what kind of the ROI improvement can be happen under the replenishment model which we are talking about?
Hi, Ritesh. I'll take this one. So under the previous model, we had no the ROI. But when we sit across and talk about this particular new model of replenishment and Lakshya projects, we actually go ahead and talk to the distributors and help them work out the ROI they have been using. So understanding that the numbers, because something you're talking on the past data and you have to rely on their numbers, they definitely would not want to show in any healthy picture. But even nonetheless, as I said, I'm sure they definitely not make anything less than 10%. That's what I would be assuming here. Whereas we are assuring them of a minimum 20% of an ROI to our new distributors. And for them, for the existing one, we are assuring of whatever they were making, whatever the ROI was there, we will definitely keep that intact. And going ahead, they will definitely benefit because a new distributors do not have any backlog or any, he doesn't carry the burden of the existing stock, whereas the new existing one does. So it takes us some time to prune on their existing stock and get them to the same level as the new distributors. But any which ways, I would say 20% under Project Lakshya is what we should be definitely achieving, and under old system, 10% is what we see.
Okay, helpful, ma'am. Thanks. That's all from me.
Thank you. I now hand the conference over to Mr. Akhil Parekh for closing comments.
On behalf of Elara Securities, I would like to thank the management of Dollar Industry for answering all the questions extremely patiently. If management team has any closing remarks, please go ahead.
I would thank all the participants here today who have been putting in their questions and hearing us patiently. Thank you, everyone, and stay safe, stay healthy. We definitely need to come out, start working, and get everything on to normalcy. Looking forward to the next quarter call. Thank you, everyone.
Thank you. Ladies and gentlemen, on behalf of Elara Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.